Okay, welcome to 23-3 Work Together, where we will be liquidating our partnership. So, as this comes up, we've got a few things that we need to pay attention to. We have our general ledger, which has all of our accounts right now that are up to date. We have our list of transactions, and then we also have our chart of accounts here that you can see. So, what we need to do here is read our instructions, which say Joanna and Stefan Salo agreed to liquidate their partnership on March 31st of the current year. On that date, after financial statements were prepared and closing entries were posted, the general ledger accounts have the balances that are shown in our question assets, right here with our general ledger. We want to journalize the transactions completed by Salo Company during April of that current year. So, Joanna and Stefan have decided that they're going to liquidate their partnership. So, the first thing we need to pay attention to is to take a look at what our transaction said. And the first thing that you remember when we start liquidating a partnership is we start getting rid of all of our assets. So, you can see the first three transactions said that we received cash from the sale of office equipment, we received cash from the sale of supplies, and received cash from the sale of the truck. So we're going to start with the sale of our office equipment. And it says that we received $12,000 for that office equipment. But what we need to realize is, or to try to figure out, is if we have a realization on a loss or a realization on a gain. So let's go to our general ledger here. And if we look at our office equipment, it says that our original balance for office equipment was $30,000. So on your calculators, go ahead and punch in $30,000. And then let's take a look at our accumulated depreciation, which has accumulated depreciation on that office equipment of $16,500. When we do that, the value of our office equipment is $13,500. Now, if we go back to our transactions, it says that we only received $12,000, which means that we have a loss on realization. So what we need to do now is we need to record the sale of this office equipment, and it has 4 steps to it actually. So I'm going to make this my question assets pop out so that I can move things around a little bit here. So this happened, and it's in cash receipts because we received cash. So we're going to put April 1st. And there's going to be 2 debits in this situation. One of the debits is going to be the loss. The other debit is going to be for accumulated depreciation. So if you look right now, accumulated depreciation has a credit balance. We need to debit it to get rid of it. The loss is going to be our other general debit. Now, according to Applia, they want us to put the loss first. If you do this in a workbook problem or on the test, I'm not going to count you off for that, but I'm not sure if Applia will if you flip-flop these 2 debits. I don't think so, but just to be on the safe side, we're going to put our loss on realization first. Our document number for this transaction is 5,000 or R. Whoops, what am I saying? 5 or R421. And if you remember, when we figured out how much our book value of our office equipment was, it was $13,500, which again is the balance of $30,000 minus the accumulated depreciation of $1,650. And we received $12,000. So if we take $13,500 and subtract out 12, we get $1,500. So $1,500 is the balance in our loss on realization. And then we have to get rid of accumulated depreciation for the office equipment. And that's a debit of $16,500. Again, that's coming from the balance here. We need to debit it to get rid of it. And then our credit is going to be for our office equipment. Oops, that asset needs to be credited to get rid of it. So we're going to credit it for $30,000. And then the last step, or step 4, is to record the fact that we did receive $12,000 for that office equipment. So our cash debit is going to be $12,000. So hopefully that made sense. These 2, the accumulated depreciation and the office equipment, essentially we're closing out those accounts. So they're just the opposite of the balance. Obviously cash is going up with a debit, and then the difference between all of these is the loss, because we only received $12,000, but if you take thousand minus 16,500, you get 1,500, and that's the difference there. So our second transaction is on April 1st. We received cash from the sale of supplies. So on this one, we're going to put April 1st. And let's go see how much the balance was in our supplies account. So if we look at our supplies account right now, it says that we have a debit balance of $2,400. And if we look at our transaction, it says that we only received $1,900. So again, in this situation, we have a loss on realization because our supplies were worth more than we received in cash. So again, our debit to start off is going to be a loss on realization. Our receipt is $422. And the realization, remember, is the $2,400 minus the $1,900 we received. So that's a $500 loss on realization. Then we need to get rid of our supplies. Our supplies, remember, have a debit balance of $2,400, so we're going to credit that. And then we need to record how much cash we received. And if you remember, we received $1,900 in cash, so cash is going to be debited for $1,900. So that is our second asset that we're getting rid of. Now on our third asset says we received cash for the sale of our truck for $15,000. So we received 15. Let's go figure out what the book value of the truck is. If we look down here, we have our truck, which we bought for $51,000, and the accumulated depreciation on the truck was $36,600. So when we take $51,000 and subtract out the $36,600, we get a value of $14,400. So remember, we received $15,000, so this time our cash received was greater than our book value, so that means that we have a gain on our realization. So on April 3rd, I just realized I put April up here and I did not need to. Ding dong. On April 3rd, we have a gain on the realization of our truck. So in this situation, our only debit is actually going to be for the accumulated depreciation on the truck. So if we go to our general ledger again, the accumulated depreciation on the truck was a credit of $36,600, so we're going to debit that to close out that account. And then we are going to credit the balance of the truck because it had a debit balance. We're going to credit it with $51,000 to get rid of it. And our other credit is going to be for the gain on realization. And if we do that, remember the book value here, 51,000 minus 36,600 is 14,400, and we received 15,000 for the truck. So our gain is $600. And then we go over to our cash debit and record the 15,000 that we received for the sale of that truck. So that is our three transactions that have to do with selling off our assets. If we go up to our next transaction, it says that we paid cash to all creditors. So after we have sold off all of our assets, then we have to pay all of the people that we owe money to. So because this is a paid cash, we're actually going to go down to our cash payments journal. And let's go ahead and look at what our balance is in accounts payable. And it says that we owe $2,500 to our creditors. So in this situation, in our cash payments journal, what we do is we put our date, which is April 5th. Again, that's under this transactions right here. What goes in the account title is actually the check mark. And it's kind of strange because up until this point, we've only ever used the check mark when we've been working with sales and a cash, receive cash. Use the check mark. But in this situation, there is nothing that's going to go in the general debit or general credit, because if we pay off our accounts payable, that would be an accounts payable debit, because if you look at your general ledger right now, accounts payable has a credit balance. So in order to close it out, we would have to debit it for the $2,500. So we put $2,500 right here. And then our cash credit is obviously what we had to pay off our accounts payable. So we get a $2,500 cash credit right here, which again is what that transaction says here, paid cash to all creditors for the amounts owed. Let's not forget to put our check number in, which is 547. Okay. And that is our transaction number 4. Okay. So at this time, what we have to do is account for the fact that we had this gain on realization, and we also had our loss on realization. And both of those are split according to our partnership agreement. So Joanna Salo has 60% and Stefan has 40%. So in this situation, we have to take our gain. So if you remember, our gain on realization was 600. 60% of that is going to go to Joanna, and 40% is going to go to Stefan. So this is actually going to go down in our general journal. So we're going to put April 6th. And our debit actually is to get rid of the gain. Because if you remember, the gain has a credit balance of $600. So we have to debit that to get rid of it. So I'm going to put $600 here. Our document number is M65. Okay. And the credits are going to go to the capital accounts of Joanna and Stefan. So we're going to put Joanna Salo capital. And she receives 60% of that $600. So when we type that into our calculator, 600 times 60%, that's $360. And same thing for Stefan Salo, maybe? I'm not sure how you say that, but we're making it work. So the 40% of 600 goes to him, which is 240. Okay, and that is the first transaction there, the gain on the realization. And then we also have to account for the fact that there were losses. So we put the 6 in here. The losses, remember, we had 2 of them. We had the $500 loss, and then we also had the $1,500 loss. So the loss is actually $2,000 total. And so since the loss is a debit, we're going to have to credit the loss to get rid of it. So I'm just going to go down to the very bottom here and type in loss on realization because it's going to be credited for the $2,000. And since it's a loss, that means it's going to reduce the owner's capital account. So what we need to do here is put Joanna Salo capital and Stefan Salo capital. And again, because it is the 60% and 40%, we take 60% of 2,000 and we end up with $1,200. And Stefan gets the difference, which is 800. Or 40% of 2,000. So just as a reminder again, a gain means that the capital is going up, so that's why capital is credited here. And a loss means that you have to essentially take money out of your capital account, which is why, oops, I should say Stefan needs to have a debit here, that's my fault. That's why these two capital accounts are debited, because there is a loss. So the last transaction we need to do is distributing the remaining cash, but we're going to do that in the next video because I'm going to run out of time here. So I'll meet you over there in the second video to wrap up this work together.